What's up, money lovers? Welcome back. So VYM, Vanguard's high dividend yield ETF, is a stock, or an ETF I should say, that I've had on my watch list for a while now, and it's one I'm considering adding in the near future. Definitely a position that I would add and I plan to use as a hedge. There's another fund that's great too, VIG. It's similar, but there are some key differences, and in a future video I'll go over the differences between VYM, VIG, and possibly even SCHD, Schwab's dividend ETF. We have made a video on SCHD in the past. You can look that up. I'll link it at the end of the video. But there's a few reasons I like the VYM the most, and this is just for my personal situation. Depending on your situation, VIG might be better, or even SCHD. If we just take a look at VYM's sector breakdown here, again, this is something that I would be putting maybe at most 5% of my portfolio into. I'm planning over time, and one of the reasons is the way it's broken down. It would give me some diversification to sectors that I have little to no exposure in my portfolio, aside from some small exposure through index funds. So you get some big exposure to consumer staples. 13% of the fund is in consumer staples. You get some energy exposure, 8%. Now, in a high interest rate environment, or these inevitable rate hikes that we're supposed to be getting from the Fed this year, financials are going to be one industry that greatly benefits from that. Those are the stocks that'll do well in an inflationary environment or interest rates rising, and financials make up 21% of this fund. Healthcare, also another industry that will do fine, almost 13%. Now, industrials and telecom and utilities, these are three sectors that I have little to no exposure in my portfolio to. I have a lot of technology exposure, so I like that that's one of the smaller parts of this fund. And when you compare it to VIG does have more technology exposure. So I think I'm overexposed to technology. Here's a look at my portfolio holdings, and many of these companies are technology companies. We've seen over the last few months technology gets hit really hard when we have these pressures. Over the long run, I am still very bullish on these companies, but I think it would just be smart to add a hedge like VYM. Now, the other reason I really like VYM is that it gets me exposure to a lot of quality, big name dividend companies. So I've been thinking a lot about this, and realistically, there's no way that I can keep tabs on every great growth company and every great dividend stock every day at all times. At that point, I might as well just be buying an index fund. So, Johnson & Johnson, this is one of the best dividend stocks of all time that I own. But the last few months and years have shown us that not even the great Johnson & Johnson is immune to things like lawsuits. Another great dividend stock I own is Clorox. And due to the macro environment, their last earnings report, the stock got hit hard. It went down 10%. And it just goes to show you that there are benefits to owning a fund instead of the one individual stock. So with a fund like this, I would get exposure to all these great companies. It would get me some exposure to financials. Home Depot, another stock that I've had on the watch list that I just made a video on. You could also check that out on the channel if you're interested. But why buy all of these companies individually when, at least for my personal situation, it would probably make more sense to just get the diversity that this ETF offers. Some of the industries I'm lacking exposure to, like financials and telecoms, basically just non-tech companies. As you can see here from the top holdings, the majority of these companies, their primary modes of business are outside of technology. I wouldn't be buying this fund to get the biggest return on my investment. That's what I have my other investments for. But this would be more so of a hedge, a good way to diversify and give me some exposure outside of technology. So that means you might actually be better off with VIG. It has outperformed in the long run here, 217% return versus VYM's only 118% return. Now, VYM, you get a slightly higher dividend. And with VIG, there's bigger exposure to companies like Microsoft. That's their number one holding. And Microsoft is one of my bigger positions already, so I don't want to double up on the technology plays. But VYM also pays you a nice 2.68% dividend. And again, that's a dividend that is higher than Johnson & Johnson's 2.5% yield. It's higher than Home Depot's 2.4% yield, and you get so much more diversity. So while those two companies are in the top 10 here, you're getting exposure to lots of other great companies like AbbVie, like all these financials. I'm not a big fan of the oil companies in the top 10 here, and oil in general, but the reality of the situation, and unfortunately like what we're seeing play out in the world the last few days, is that oil is something that is a necessity right now. It's not going anywhere in the short term. So I would really be getting into VYM just as a hedge to get me some further diversity in my portfolio for the rough times like we may continue to face in a year like 2022 with all this uncertainty in the market and interest rates going up, rate hikes coming, inflation. This would be one of the ways I would hedge it. So let me know in the comments below. Do you like VYM? Why or why not? What fund would you buy over it? If you enjoyed the video today, don't forget to like and subscribe. This is Vinny from the Investment Club, and I'll see you next time.